Good afternoon, everyone. Welcome to the MSMF Wealth Management Client Podcast for March of 2023. By the way, we need a new name for that. That's just too much for me to get out of my...
March today.
There you go. There you go. And it's a big week. We got St. Patrick's Day coming. We got Mizzou, hopefully at least going past the first round of the NCAAs. By the time we get this, we'll know how far they went. But that's all been overshadowed by some things that have been happening since last weekend. Right. Things that, quite frankly, have me mildly off, okay? Which is why you guys are going to do most of the talking because I will get very fired up, right? So the title today is Financial Threats We Didn't Know That We Faced. And I'm joined, as I always am, by my dear friend Cody and my friend Jay, and we're going to help everyone figure out what these threats are that we really didn't know were there, some of the stupidity that caused them, where we think this is going, and really what clients could do or should do, okay? To start with, let's talk about the financial threats that we always talk to our clients about. You know, it's too much spending, it's not saving enough, it's taking too much risk in a portfolio. We'll come back to that in a minute. Credit risks in our personal credit score, healthcare risks, all of these risks that we try to prepare our clients for and do on a day-by-day basis as we help them kind of create and monitor their financial blueprint. But this week, we found some threats that we thought were taken care of by very smart people that were not. So the first one we'll start with is what I'll call economic and financial policy decision makers, okay? The people that are supposed to be the really smart people in the room. So Jay, get us started with, Cody, get us started with, I'll figure out my notes in a minute, my handwriting. Cody, get us started with what's been going on this week and kind of from a 10,000-foot view down to the 5,000-foot view, just what the heck is happening?
Yeah, so, obviously, if you haven't been hiding underneath a rock, you would notice some headlines about some banks going under. We had I believe it was the second and third largest banks to have to basically get rescued. FDIC insurance coverage kicked in U.S. history. So that's number one was Cody in 2008. So kind of what started the whole process and why is this becoming in the news right now? You have to go back to when we had COVID. Even go back further than that, the last decade, just low interest rates in general. Yeah. All right, so low interest rates for about a decade. And then you had COVID happen. And what happened in COVID? We had stimulus checks, right? I think there's
shelling out the money.
three big stimulus checks that sent out, corporations and personal people included. So all that money went and basically was available to the public to spend. So, we call that the M2 money supply. What money is out there? Cash, savings, CDs, it doesn't matter. It gets all included. That grew 26% a year.
Oh, boy.
Yeah. Biggest, you go back and look at the charts, it's the biggest jump I've ever seen.
Too much of a good thing is too much of a good thing.
Too much of a good thing. Then what happened?
There's no repercussions.
So if you flood all that money into the system, so let's say that I think it was close to 30% of all the money we ever printed was printed in like 2001 and 2002, so like in a year and a half time frame. So, easy math out there just from a back of the napkin view. If you have 30% more money and something costs $1, well, then you would expect it to what? Cost like $1.33, right? That's kind of inflation. I'm not talking about supply chain stuff. I'm just talking about available money out there. Because there are different types of inflation. Mm-hmm. So then we kept hearing the words transitory, right? Transitory. That is the supply chain part. Yes, that has gone down a lot, that part of the inflation. But you can't just get rid of all of the money that flooded the system. So people were spending, right? They were going on vacations. They haven't been on vacation in a couple of years. They were getting that new deck put on, the new patio, swimming pools. Think about the waits you have for things still today.
The new TVs.
TVs.
G.I. Joe with the Kung Fu Grip. Name that movie.
Cars, right?
New cars.
Cars, yep. So all that going into circulation, and now what we're coming to is basically all that money, stimulus money out there has been spent. And how do we know that? Well, we go back to the M2 money supply, and we actually see that it's retracted or contracted a bit. So, now we have negative growth in the M2 money supply. So that means that people are having to go out and either, one, borrow money, use their credit cards more, or dip in more into that savings bundle that they had saved up, right? So, in fact, since 1948, this past year here was the first time since 1948 that deposits actually were lower than the year before. So we've had a pretty long stretch where deposits grew, and all of a sudden we contracted a bit. Why? Because money's a little bit harder to get to. So we have a liquidity issue. People don't want to go and borrow money because why? It's expensive right now. Relatively compared to what it had been for the last 10 years. And then, the Fed's reaction to inflation going back to its transitory, basically at the end of the day, they were a little bit too slow to move, right? We wish they would have started doing something in 2021 and didn't wait until March of 2022. So basically, they raised rates about 4% in a 9-month period, which we've never seen that happen before. So in less than a year's time frame, you had 10-year Treasury rates, really grow by about a little bit over 3% from beginning at 1.5% to now over 4.5%. And all this kind of snowballs together here. And then we had the banks in the background. What are they doing? They're buying government securities, mortgage-backed securities, treasuries and mortgage-backed securities. And they probably lengthened the maturity of some of those holdings that they had a little bit. They're supposed to be short term, meaning that as the new money comes in, the short term they loan out the rate, they make the difference on the rate, and they turn it over and they buy a new bond again. They started lengthening that maturity because they wanted a little higher yield. Mm-hmm. Okay, so then you have not enough deposits going into the bank, and you have more withdrawals started. You have excess reserves that are in long-term bonds, and those are earmarked to hold to maturity. And then when you have people start making those withdrawals, you have to dip in to your long-term bonds, and guess what? They're at a loss right now. All banks out there are holding long-term bonds at some sort of loss. Sure. And that really started kind of the run on the banks, I guess you would say. People are trying to get their money out before they couldn't. So long story short, we haven't had a run on the banks in a while. There was, it's kind of called contagion, I guess you would say. But I think Jay's going to talk a little bit that here further. So take it away.
So let me ask a question as you dive into this. So all sorts of free money creates inflation. The Fed sits around, doesn't do anything. They wait too long. I'm sure my daughters in their high school econ class could have figured out what was going to happen with all this free money. So the Fed waits around. They finally raise rates, right? Certainly, as it relates to bank and extending maturities, although, quick side note, we've had our clients in short-term bonds for quite some time.
Right.
So I would have thought that if we were having the consumer do that there's regulators and really smart people, Jay, to help the banks understand that.
You would hope so. And I would kind of think that's kind of their job, right, is to kind of monitor those things and make sure that they don't get their maturities out too late. They have enough deposits on hand for if there is some sort of run on the banks, those types of things, above and beyond just the normal, regulations that banks have to deal with anyway. But that addresses another financial threat that we didn't know about. They weren't really paying attention to what these banks were doing in the background of guaranteeing their deposits. So that way, when everybody goes to the I won't say the bank names, but it goes to those banks and they're trying to take out all their money all at once. And by the way, 86% of that one particular bank you're thinking of 86% of those account holders had over the FDIC limit of $250,000 that's guaranteed in insurance. So 86% of those people were making really large, withdrawals, not taking out $10,000. They were taking out like $10 million at a time. And so that's what kind of snowballed into the effect of everything that Cody was leading up to. So just another, I thought someone was watching this. I thought someone was paying attention to this, right? That's just wild. So fast forward to, okay, well, now we have to ensure safety of everybody else and try and reduce panic and make sure everybody across the nation isn't going for their banks and withdrawing everything. That's where the Fed, the FDIC, the Treasury, they all came in and said, okay, we're going to stop this. We're going to stop the run, and we're going to cover all of the deposits over the $250,000. Well, cool. There's another financial threat we weren't aware of. Now we have to pay for that when it wasn't necessarily in the budget to cover those expenses. So yet another one, right? And then the last one, and kind of talking about what Cody's talking about there, how far does this contagion go? How many other banks are at risk? If these three in particular aren't paying attention, are other banks? Do we need to be worried about our money? Do we need to be taking our deposits out right now? In which case, I'm going to go ahead and say I don't think you do need to, because one of the things you can do is after the 07-08 financial crisis is they put together on the federalreserve.gov website, you can go out there and do a stress test on your bank. And so if you do that, we were just looking at it earlier, and it looks like, according to the website right now, they could cover up to $600 billion worth of deposits should there be a run on different banks. So that to me makes me feel a little bit better that, first of all, there's a backstop to it. But second of all, it was very unique, the types of banks that are having these runs on it. They're venture capitalists. They're supported by blockchain technology and all the cryptocurrencies and all of that. That's not your everyday bank.
Correct.
Most everyday banks should be fine coming out the other side of this. So there you go, more financial threats that I didn't think about until last week.
Right. And I think that, to your point, the good thing about this particular financial threat, really smart people we have confidence in making really dumb decisions, right? To your point, the banks in question, particularly, we haven't talked about this, their loan portfolios were very concentrated, a very focused type of business. Out here in the Midwest, at least the banks that I know we do business with, that our clients do business with, their loan portfolios typically are much more diverse than the two banks in question. And that right there addresses a lot of this issue. So while this threat is out there, and thanks for the resource, people concerned, they can go see the results of the stress test on their own bank. It's public information. We don't think that risk really exists around here, right? There are obviously a lot of funding of the promotion of the fear on social media, which we'll get to in a minute. But while we didn't know about this threat, or didn't acknowledge that it be a possibility that so many smart people could make such poor decisions, I don't think the risk is giant here in the Midwest. The next threat that I think we all know about, but I want to bring up today because it's happening more and more and more, is knowing bad actors that are trying to steal access or steal financial information or access to accounts. Jay, talk to me a little bit about these bad actors. I know if you've had clients call you with concerns, what are a handful that you've seen lately?
Yeah, the number one is just straight up identity theft. And it's really important to think about it right now because what's the number one identity theft that happens for a lot of people? Tax returns. And so, as a lot of people are filing their tax returns, they're probably getting some bad news that, oh, I'm sorry, a return has already been filed in your Social Security number. Right. I don't know how many people I've talked to that have had that. So just protecting your what is it, personal PI, personally identifiable information.
Yesterday's Pi Day here.
Another holiday. Keeping track of that and monitoring that and trying to maintain some security there, for identity theft. Another one, and this one's wild to me, phone cloning. So they somehow, and I say they, so we talked about, intelligent people, right? Someone smarter than me, obviously.
Yeah, these are super intelligent, really bad actors, right?
Just pointed in the wrong direction. If we could just
Right.
point in the right direction. Anyway, they figured out how to clone people's phones so that they can gain access to all kinds of stuff. Basically, anything that's on your phone. And I don't know about you, but I can access pretty much every part of my life from my phone, including my investments, my bank account, my everything. So that's kind of a scary thing. I wish I had advice of how to, protect yourself from that. I don't even know what to do
Don't
about
leave
that.
one laying around for sure.
Number one.
Yeah.
Another one, speaking of phone, are just phone scams. So whether it's people texting you and asking you to do things, I got a phone call today, just a couple hours ago, saying, hello, I'm sorry, I can't hear you, because they're trying to get you to record yourself saying your name and hello a bunch of different ways. By the way, just hang up if you get that. And then another one is, the IRS called me and I owe a bunch of money. So the Social Security office called me. I need to do something.
My favorites.
No, the government entity will not call you.
Ever.
Please hang
They
up.
Never call.
If you get that call, just hang up. That is not the way that works. And then another one I wanted to add to the list here. Chris, behind the scenes there, was just talking about this. Social media. People are using social media to do a lot of great things and a lot of bad things. So you may have seen additional profiles pop up. That's a big one. And the first thing they do as soon as you talk to them, hey, can I get some money?
Right.
I don't know you. But you want to help your friend, right? So you think it's your friend or your family member. That's a really popular one. Just be careful with those couple things. So I think, Cody, you've got a couple more there.
Yeah, I wish that was the only list, but there's more.
Yeah. but
Yeah,
wait, there's more.
Online credit card theft. So we talked about this on the last podcast we did about always using your credit card versus your debit card. So if something does happen, the credit card will go and fight on your behalf. If it's debit, it's your money in the bank, and it's a lot more unlikely that you'll get the money back if it's your debit card. Where the credit card, wasn't your money in the first place. So, just be aware of those. They happen all the time. A lot of places you can go online, and if you notice your credit card was stolen or whatever it might be, and you can shut those off pretty instantly. Email scams, kind of like what Jay was talking about with text messaging, but they do the emails. This one we face in our industry all the time. There's a reason why, yes, you can send us an email, but we're going to call you if you're asking for a withdrawal of your money or to make a trade, because unfortunately people get their emails hacked and they ask for this type of thing, or to send me money, whatever it might be. So we have to definitely, and it's happened. So we're glad that we do call.
Exactly.
We will continue.
Right.
Yeah. And Mark even has one on here that I think he wants to talk about, and that's roofing scams, Mark.
I just told you guys this. So I took a phone call the other day. Hi, this is ABC Roofing Company. We're offering free roof inspections in your area due to the recent hail damage. Now, a lot of stuff goes over the top of my head, but we haven't had a hailstorm in a while. So I just let this gal continue to the end. She's like, can we come over Tuesday or Thursday? Well, I let her finish because I then told her, by the way, I live in a condo and I'm not responsible for the roof. So you obviously have no idea where or who you're calling, and hung up on her. So the scams are everywhere. And I know a lot of our clients know this, but we always urge them in this second threat to tell your friends. Most importantly, if your parents are still living, please tell them, because we get those phone calls all the time. Hey, my mom got called by somebody and, they wanted her credit card number because they were going to fix something, blah, 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 blah. Never give your credit card number out. Warn your parents, warn your siblings, warn your 20-something kids who are now in the workforce that, if it doesn't smell right, don't do it, right? Because there are bad actors out there, and they're smarter than some of these dinglings that are making the decision on threat number one, to be fair. So lastly, threat number 3, really, and we do say this all the time, but I remind everybody, it's our own emotions. So whether we're talking about what's going on in the banking system right now, the economy, the Fed, whether we're talking about bad actors, please take a deep breath, right? All of these things are going to get worked out. The bad actor part, if you don't respond to something that smells fishy, because it probably is, and the banking stuff, it's going to get worked out. Chris, you talked about Chris behind the scenes. He basically said, hey, this is a liquidity problem for these banks. It's not a solvency problem, right? And that's a major difference. It was solvency back in 2007 and 8. This is 1,000% different. It's a liquidity problem and a poor management problem. So take a deep breath. This is all going to work its way through. We're going to see some market volatility as we move forward, but things will be fine. Don't let your emotions be your worst enemy. Cody, what other things in closing that you would want to say to clients to get us through this phase?
Yeah, I'd say, if you want to first of all, make sure that your bank is FDIC insured. There are multiple websites out there where you can go and check that. If you want to talk further about, because we were looking it up, the different types of insurance that FDIC will do in one bank, because it's confusing. More than happy to help out with that. Going back to what you said, Mark, is nothing to panic about. You're going to hear bad headline stuff in the news. Just know that the news makes their money from making the headline look really bad, so you read it. So if there's questions that you have or concerns on your account, certainly just give us a call, and we're more than happy to talk about it.
Jay, what do you think?
Yeah, so I'll take a little bit towards like more investments, right? What can you do with everything that's going on? Well, first of all is take a deep breath and kind of buckle up, right? Because most of our clients, they already have a diversified portfolio, an allocation that's built to handle these blips that happen. And that's the thing. These different types of events are always going to happen. And so as long as you're taking the appropriate amount of risk, not too much, then your portfolio is probably already built to handle something like this. But that's also why we periodically review it. We want to make sure that when the next thing happens, because there will be a next thing, that we're all on the same page. We're all talking about it. So I wanted to kind of throw that out there, and then add that with your investment accounts, there's also kind of like an FDIC, but it's not the same, called SIPC, SIPC, in which case there is another insurance coverage, again, protecting your account from if there is some sort of liquidity event on your stock type of accounts or fraud, right? It's got more to it, but right. trying to just make sure you know that there's additional coverage that we have too.
Right. Excellent. All right. I appreciate both you guys. Great comments. A little bit longer today, but I think it's worth it. Please feel free to share this with any of your friends, families, colleagues who maybe are hyperventilating a little bit based on what's going on, because there's really no need for that. I think listening through to these threats would help them. And then obviously if you had any questions, reach out, call Cody, call Jay, call myself, use the text line, use our Cetera FS emails, and we'll be happy to pick up the phone and call you and chat you through this. So in closing, MIZ. See you next month.